Hello and welcome to Moneylife News and Views. I'm Debashis Basu. Last Friday, the shares of Delivery, a newly listed logistics company, fell almost 18%, announcing that business volumes in the last quarter, which is the September ended quarter, has been weak. Delivery claims to be building what it calls an operating system for commerce. Now, that's a very big, ambitious idea through a combination of world-class infrastructure, logistics operations of the highest quality, and cutting-edge engineering and technological capabilities. But it does not make any money. In the June quarter, it reported a loss of 308 crore, which on an annualized basis is much higher than the whole year's loss of 2022, which is about 864 crore. Now, with a few hundred crores in the bank and a few hundred more crores in financial investments, it will not be long before Delivery runs out of cash and takes steps that would dilute the existing shareholders through rights issues or some such. It is the same story with another tech company, a new age food delivery business called Zomato. Like Delivery, Zomato has made no profits in its lifetime. It has been losing around 1,000 crore a year, though losses seem to be reducing a bit now. Along with these two, there were others also which went public last year, which is Policy Bazaar. The official listed name is PB Fintech, Cartrade, and Nykaa. They have also been steadily losing value as investors wake up to the fact that there is no chance of these companies ever making any money to justify the current lofty valuations, even after these stocks have dropped about 50 to 60% from the listed price. The market regulator, Securities Exchange Board of India, has announced tighter disclosure norms for these kinds of issues, which I discussed last fortnight, but these are of no practical use. In doing so, SEBI has also skirted the issue of the accountability of the lead managers and who actually set prices. Another aspect of this picture that goes unnoticed is investments by mutual funds in these dubious companies. What is the application of mind in making these investments and putting investors, that is mutual fund investors, money at risk? For instance, Long-Term Advantage Fund Series 1, 2, and 3 of the Tatas holds Delivery shares to the extent of over 3% of the portfolio. Paytm finds a pride of place in Tata Nifty Digital ETF, Mirae Focused Fund, and also HDFC Nifty 100 Equal Weight Index. Nykaa, which reported a semblance of profit, unlike the other tech stocks, is present in the portfolio of Tata Nifty India Digital ETF and Invesco India Focus 20 Equity Fund. Policy Bazaar is there in Tata Nifty Digital ETF, Franklin India Opportunities Fund, and Franklin India Technology Fund. I have only picked up the top 3 schemes with the largest exposure today. There are plenty of other funds with smaller exposures and also those that entered and exited at a loss in these stocks. SEBI assumes that arming retail investors with more disclosures, with more information, would lead to better investment decisions. If that is so, how is it that mutual funds who are armed with deep research and information and charge a fee for fund management have invested in these loss-making stocks that are continuously sinking? A common argument in favor of mutual funds is that a stock may sometimes look attractive at the point of investing, but lead to disappointing returns. This is part of the normal investing process of hits and misses. However, this process cannot be an automatic justification for investing in any stock. There has to be more probity in investing public funds when they buy loss-making, overvalued stocks and give an exit to privileged private equity investors who made their investments at a fraction of the value. While explaining the buying process, most funds focus on fundamentals of the business, such as sales and profit growth, return on capital, free cash flows, and so on. These fundamentals are then matched with valuation parameters such as price to sales, price to book value, price to earnings, price to cash flow, and so on. It would be ideal to find a stock with improving fundamentals at a low valuation, but this happens only after a bone-crushing bear market. More often, fund managers settle for a trade-off between improving quality and moderate valuation, which has yielded expressions like growth at a reasonable price, since earnings growth is the most favored of all of these fundamental factors which I just mentioned. Fund managers can go wrong in estimating growth and end up buying a dud. That is perfectly understandable. But if fundamental factors themselves are rotten, no profit growth, losses, negative cash flows, and so on, how can they justify investing in such companies? No valuation is low enough in these circumstances. And yet, such high price stocks have crept into the portfolios of several funds. The only reason to buy stocks with no embedded quality is speculation. You're just expecting that you would buy it at X price and you'll flip it over to somebody at a Y price, which is much higher. Now, this kind of thing is actually trading, and trading without, irrespective of the intrinsic worth of what you're buying or selling. This is also a legitimate strategy. There are traders, millions of traders everywhere in the world which is doing this, who are acting on price patterns alone, but mutual funds don't claim to be short-term traders, which popularly they are called bhav ke khiladi. In short, while SEBI is focused on weighing down direct retail investors with more disclosures, mutual funds as experts and custodians of another set of retail investors' savings play a speculative game they're neither supposed to nor equipped to. Now that these highly visible new age high-tech companies are listed and traded daily, we have come to accept them as part of our lives. So it may seem incredible, but without a public listing, they would have died a natural death, having burnt oodles of cash belonging to rich investors. These investors got an exit when these loss-making companies were allowed to enter the market through SEBI's generous but flawed listing regulations. But it is hard to see why mutual funds, with a mandate to be responsible with retail investors' money, should also be part of this speculative nonsense. That's all from me today. If you liked it, please subscribe and please do share. Thanks for watching.